Okay, now we're going to talk about Chapter 11. We're going to talk about accounting for bonds payable and how we account for issuing a bond. And we're going to start with bonds issued at face amount, and then we'll do discounts, and then we'll do premiums. So bonds issued at face amount, this would mean that the market rate equals the, remember for our prior one, market rate equals the contract rate, which means it is sold at face value. So the example they give in the book, they have a face amount of $100,000. $100,000, the market rate of interest is 12%. The contract rate of interest is 12%. The term in years is 5. And it is paid semi-annually. Okay, so twice a year. So since these two are equal, we know we're going to actually sell the bond for $100,000 because those two are the same. And we can see by our present value calculation that's the case too. That's the face value, which is the same as the, I know it's negative. That's just, I don't want to go into detail about why that is with time value money. My initial value always comes out the opposite direction as my other value, but we won't go into that in this video. Bond issued at face amount. So when I'm issuing a bond, I'm actually receiving money. I'm receiving cash. So I am receiving cash in this case because it's at face value of $100,000. And then I need to book the fact that I owe, I'm going to call this bonds payable. It's a liability account for $100,000. So that's my initial. This is when I issue, or you can call it sold the bond, whichever you want to say. When I issued the bond, sold the bond in the first place. The initial issuance is what that would record. So then every 6 months, this would be, in this case, on January 1st. Every 6 months, I'm going to pay interest. So we have June 30th. I'm going to pay the $6,000 of interest. So I'm going to have interest expense. And I'm going to do $6,000. And I'm going to credit cash. So I'm increasing interest expense because I'm paying interest, and I'm decreasing cash because I'm paying my interest with cash. I would have this same entry, because I need to type it twice, have the same entry on December 31st. And I would have that same entry twice a year, every year for the next 5 years. So I would be paying $6,000 every 6 months to the bondholders, whoever's holding this bond. And then at the end, so this would be December 31st of year 5. So the end, after it's all done, so I've already paid all my interest payments, I'm going to pay back the face amount. In this case, that is $100,000. So I'm going to pay back and pay off that liability. So I can debit bonds payable to get rid of the liability, and I can credit cash, because I'm paying it off, for $100,000 to show that I paid it. So this is the initial issuance. These are 2 examples of interest payments. Remember, I'd have 2 a year for 5, in this case for 5 years. And I would then pay the entirety, the face amount of the bond payable off at the end of year 5. And so the next one we'll talk about, next video we'll talk about bond discounts.